By mistake, I was selling something in one account and buying something in another account, and the trades crossed with each other. And purely by mistake, I had a wash trade. I had to explain myself in a very long email of exactly how I did it, what I was doing, the event, everything. I had to explain myself. So, wash trades can create that volume and give the impression that there's something there when there isn't. That's manipulation. If the intent is to create that impression on others, you're manipulating. Securing a dominant or controlling position in a financial asset to exploit and manipulate the price of a related derivative. This is called cornering. Again, that's illegal as well. But if you want a great story of cornering, go back to the 1970s and Google Hunt Brothers and silver and have a look at what they did with the silver market. They almost pulled it off. But I'll tell you something. This is going to be very difficult to do today, especially with position limits and especially with position limits in derivatives. The market has figured out all of these ways that the market can be manipulated, and a lot of safeguards are in place that makes manipulation very difficult to do. Not that it can't be done. It's just your job is going to be a lot harder now, and because it's a lot harder, you're going to leave footprints. Simple as that. So you're going to get caught. You know, maybe not this time or the next time, but eventually you're going to get caught. So, Standard 2B excludes legitimate trading strategies. As I said on the first screen, that there may be instances where you will move markets and you will distort prices and trading volume. But if your intent was honest, was clean, was just that you really just didn't know how to execute better, you're okay. The key is intent. So let me give you this example. And it has some intent in there, but it's a trading strategy. And you tell me if you smell anything funny here. I own 2 million shares of ABC, and let's say ABC is a small float stock. Let's say it only has about 12 million shares outstanding, and let's say the average daily volume on this thing's about 200,000. I own 2 million shares of ABC. I'm going to sell them. I want to sell them. I can't find a large block order. I'm going to have to hit the market with this, but it's going to take me weeks to unwind this order without moving any volume, without leaving footprints. So I figure, look, I'm going to leave footprints. I know I'm going to leave footprints, so why not take advantage of that? I'm going to move the price. So before I sell, I begin to buy puts on ABC. I begin to buy puts. I wait until expiration date because I want no wiggle room. I want to end the day down. I don't want any rebound. I don't want anybody to figure this out. I want to end the day solidly down. I want my puts to be solidly in the money. On expiration day, I sell hard into the close all that I can. Now, while I'm selling, I'm convincing other people that they should be selling as well because the price is dropping and I just keep hitting the market. I keep hitting it and hitting it. I'm hitting the bid and I'm moving it lower. Hitting the bid and moving it lower. Yeah, I'm losing on the liquidation of my position, but every time I push that bid lower, my puts are blowing up. The premiums are nice. I'm making a ton of money on that side. So I don't mind using these 2 million shares as ammunition to torpedo that price lower because my puts are blowing up. The reason I wait for expiration date to do this is because I don't want to rebound the next day. I want those. I don't want to wait. I don't want to have to get out of the puts. I want them just to expire in the money, period. So I wait until expiration day, I sell hard into the close. My intent is to make that price as low as possible on the close and on the expiration date so no wiggle room at all. There's no risk the next day with the price rebounding and the value of my options disappearing. Am I manipulating the market? I'm using a weakness in the market. I'm using the weakness that today is the expiration date on those options. That's a structure of the market that I'm using. Am I using non-public, non-material, am I using, let's get rid of that am I using material non-public information? Now you may think, well, what kind of material non-public information have you got? Well, I'm buying these puts knowing that 2 million shares are going to hit the market. They're my 2 million shares, but I'm acting on information that I know. I know I'm going to move that price, and I'm buying another asset that's going to benefit from my action. Is it deceitful? There are people that, when I'm buying these puts, there are people that are thinking, well, I'll sell the put. The probability of the price dropping in the next couple of days to expiration is very small. I'll sell that put. Meanwhile, I know I'm going to hurt them. I know I'm going to crush them. So am I being deceitful? Am I being dishonest? I've put this to students many times, this scenario. And there are some who say, you are simply just following a strategy. It's a very good strategy. And there are others that are saying, oh, but you're hurting people. You know you're hurting people, and you're going ahead and doing it. So that they would say that while it might not be manipulation, and they say, well, there's no material non-public info because, well, you know you're going to sell. It's just like if I know I'm going to buy, should I not buy because I know I'm going to raise the price? Okay. But deceitful and dishonest, there's a big agreement that that's deceitful and that's dishonest. Leave a comment. Tell me what you think. Standard 3A, loyalty, prudence, and care. The member or candidate has a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. They must act for the benefit of their clients and place their clients' interests before their employers or their own. This is going to create a conflict between this. You can get rid of that conflict easy. That one's easy to get rid of. Place it before my own. Well, that's the whole idea behind it, right? But you owe a duty of loyalty to your employer as well. You owe a duty of loyalty to your client, but you owe a duty of loyalty to your employer. I think you can see that in certain situations, a conflict may arise. So let's look at some guidance here. In some jurisdictions, before we move on here, in some jurisdictions, this duty of care may actually be fiduciary. That means it's a legal requirement. So that you have a legal obligation now, not just relying on standard 3A, but a legal requirement. 3A is not a substitute for any legal obligation. You don't have to say, oh, well, I'm bound by this. I can ignore the legal obligation. No. Remember now, as per 1A, the more strict obligation applies. If duty of care is fiduciary, that rules the day. Beyond the duty of care that you owe to the client, you also owe a duty of care to their assets. If you have custody of client assets, there is a heightened level of responsibility. And that custody can either be direct custody, where it's pooled funds in an account in your company name that you have direct control over. Maybe there's no custodial arrangement outside of your own firm. Or maybe you have indirect access to the funds where you're managing an account, but you have power of attorney over execution and deposits and withdrawals in the account. You have a heightened level of responsibility, clearly, right? Let's move on. Identifying the actual investment client. In short, it's the beneficiary. Not the person. It's not necessarily always the person who hires you. It's the person who is the beneficiary of the funds that you have. So if you take a pension plan or a trust fund, the client is not the person who hires the portfolio manager. The clients are the beneficiaries, the ultimate beneficiaries of the fund. So you have to manage the pension fund with the end client in mind. You owe them a duty of loyalty. You owe them a duty of care. You owe them prudent judgment, not the person who hired you. Sometimes there may be no beneficiary. And this may seem rather odd that somebody somewhere is a beneficiary, right? No, let's think about an index fund. What is my mandate when I'm running an index fund? It's to match the index, no matter what happens. So let's say there are a couple issues in the index that I know that, these are just awful stocks. They're going down. I know they're going down. I know they are. Do I owe a duty of care to the holders of that index fund to say, look, I'm going to underweight these for you? Or do I owe a duty of care to the mandate to say, look, win or lose, I'm just going to stick with my mandate. If some of the issues lose, well, that's tough. That's not on me. That's just the mandate I have. Well, if you're running an index fund, you have to stay true to the mandate. There is really no beneficiary in that particular sense. Decisions do not have to be based on beneficiary requirements, only to the mandate. So if a couple of stocks are kicked out of the index and new ones are brought in, you rebalance. Whether or not it's in the beneficiary's best interest, you say, look, if it wasn't in their best interest, their money manager wouldn't be putting them in this index fund that I run. So the money manager is expecting me to match the market. That's all I'm going to do, period. Moving on, developing the client's portfolio. Big word here, suitability. Was it a suitable action that you took? And now, we have to be careful about using this word suitability in isolation with a particular investment. I may select an investment that on its own is not suitable for a particular client, may be completely unsuitable for a particular client. And the argument could be raised that, you've breached your duty of care. You're in violation of this particular standard. My proper response should be at that time that, hold on a minute. I take a portfolio approach. You cannot assess each of the elements individually for suitability. You must look at them in the context of the whole. Sometimes the addition of a risky asset to a portfolio actually lowers portfolio risk. We've done all of this in portfolio management. If you don't know that yet, you're not ready for this. So suitability, let's match it up with this final statement down here. Decisions are judged in the context of the total portfolio, so that if I did it right here, my duty is satisfied with respect to a particular investment at the level of the whole. I must disclose all potential conflicts of interest to the client. Remember, earlier I said I owe a duty of loyalty to the client, but I also owe a duty of loyalty to my employer. That may bring up a conflict. I might want to, or not may, I should disclose that conflict. I may also have a conflict in terms of the fees that I'm being paid for particular investments. I may want to disclose what I'm getting paid based on every fund that I'm selling. Client guidelines are followed. So if what this means is that go back to the investment policy statement, there are guidelines in there as to what the objectives are, what are the proper assets to invest in, what assets should be excluded, so they are being followed. Soft commission policies. This is a way of smuggling services into an account and having clients pay for them. Payment of higher brokerage commissions to purchase goods or services that don't benefit the client. So let me give you an example. Let's say that there's a particular stock that I'm looking at and I need some research done on it. I'm a portfolio manager. I'm not going to spend the time doing the research. I purchase all my research. I can purchase the research directly, or I can purchase the research from wherever I'm clearing my trades from currently, and just agree that the price of the research will be smuggled in higher fees. So it doesn't come out of my management fee, it comes out of the brokerage fee. So the client's actually picking up a cost that the management fee should pick up. Remember, when I'm running a fund, I have a 2% management fee or a 1% management fee, and from that I manage that fund. I run my office, I do my research, all that stuff. And then the brokerage fees are for the actual trading. Well, if you're going to sell me research, why should I pay for it? Hey, listen, I'll agree to a higher brokerage charge and just give me the research. So that's what soft commission policies are. Payment of higher brokerage commissions, because that belongs to the client now, to purchase goods or services that don't directly benefit the client. Now, you can argue that, well, but the research does benefit the client. Only if I buy, or only if I'm holding it and I sell, only if it leads to an investment action that adds value. But if it doesn't lead anywhere, well then it shouldn't come out of the client's end. Still on soft commission policies, there is something called directed brokerage, and this is where the client directs the manager to purchase goods and services for the client. This is not a violation of 3A. The client is directing you to go ahead and do it. You still must get the best execution and the best price. You're still bound to do that, but you're not in violation of 3A. You're not using client brokerage for your own benefit. You're using it for the benefit of the client, and you've been directed to do so. Proxy voting policies. You should disclose when and how proxies are voted because you're holding securities for the ultimate beneficiary. Voting is a powerful thing. And if you don't vote, you might be giving up some right that the client has. So you should have a policy of, do we vote these proxies? Do we vote them under certain conditions, or do we always vote them? Recommended procedures for guidance, regular account information, quarterly reporting to your client, the funds they have, the securities, all the transactions that occurred. Custody disclosures, where's the money? Who has the money? Is the money going to be transferred? Who owns the assets? Where are they sitting? Client and asset segregation or separation. If they're separately managed accounts, they should be segregated. They shouldn't be pooled funds. They should be separate and segregated. Continuing on with guidance, client approval. That's an easy one to do, right? When in doubt about a course of action, ask. At the level of the firm, what kind of procedures do we have here for guidance? And I'll tell you something, at the level of the firm here, many of these are just things we've already talked about. There's nothing really new or interesting here. It seems like just common sense. But here is the point of all of this. I'll go through each one and you'll say, yeah, but that's just all, we've covered all of that in a whole bunch of different places. That just seems to be part of the job, right? Well, here's why we're talking about firm policies. These are all policies that exist, whether the firm takes them or not. Look at the first one, follow all applicable laws and rules. Well, duh, right? But unless a firm actually has a written policy that says that, unambiguously, there's a big difference between a firm handing you a booklet saying, here's our policies, that's your responsibility to know them, and you reading them saying, oh, okay, they're aware of all of this and they're taking it seriously. That's what this is. It's just the firm saying, look, we're aware of all of this stuff. Let us remind you again what your duty of care is. Your duty of care and prudence is to follow all applicable laws and rules there, buddy boy. Establish the investment objectives of the client. Well, that's the investment policy statement. You would say, but that's part of portfolio management. Sure it is, but the firm is just reminding you, hey, look, don't forget to do that. Consider all information when taking actions. Well, that's just prudent investing. The suitability of a particular investment for the client. The right security for the entire portfolio, the addition of an asset to a portfolio. Well, we learned all of that in portfolio management. Again, yes, you did. And this is not new information. It's not like, okay, I got to remember all of this. Okay, what does the firm want us to do? It's just the firm writing down and codifying what you should already know, but never discount the power of the written word to remind you of something, that the firm suddenly has a policy and it's written down and there it is, and they're reminding you that they know what you should be doing. That's powerful. Diversify, obviously. Regular reviews. Do the investments match the objectives? Deal fairly with all clients with respect to investment actions, and we'll get to this one here shortly. Deal fairly with all clients with respect to investment actions, such as allocating trades. We'll talk, this is part of another one, but it's all part of loyalty, prudence, and care. Some of the other policies that a firm might want to put a few sentences down about in the employee guidebook. Disclosure of conflicts of interest. How is it done? When is it done? What they consider to be a conflict of interest. Disclosure of compensation arrangements. If you're getting paid significant amounts of money from one fund to bring money under management, and that's much more than any other fund, but for some reason it's still a pretty good fund, well, you should disclose that. Because let's say the fund doesn't turn out to be so good and it was found out that you just were getting paid a lot of money for it. Well, that doesn't look good. A policy on how you vote proxies. Maintain confidentiality. There should be very clear written statements that you got to do that. You can't be out somewhere saying, oh, you see that guy over there? Man, he's got a lot of money. You can't say anything about anybody's account. Oh my God, you can't say anything about that. Just keep that in mind. Seek best execution. That's your job. Your job is to get the best execution, not just trade it away just to say, there, I've done it. The client wanted me to buy, I just bought. No, no, no. You still got to do the best you can on price. Place the client's interests first. Well, we ended the last standard with the words deal fairly. So guess what the next standard is? Standard 3B, fair dealing. Let's see what it means. The member or candidate must deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, taking investment action, or engaging in other professional activities. Now, let's be clear about something. Fairly does not mean equally. Fairly means equitably. There's some people who think that equitable and equal are the same thing. They are not. If you put forth a lot of effort in your career, and you're making $1 million a year, and somebody doesn't do anything, drop out of high school, they don't care, they kick around, and they have a minimum wage job, and they get paid minimum wage. Is that fair? It's not equal, but is it equitable? Yes, it's absolutely fair. I'm always amazed at how people at the bottom think that income distribution meaning people who make a lot and people who make a little, that income distribution that's not equal is somehow unfair. Oh, it's not fair that people at the top make a lot of money. Well, look at their backstory. Maybe they put in a lot of work and a lot of effort. It is fair. Fairness does not have to be equal. It just has to be equitable. So let's be clear. When we use the word fair dealing, we're not meaning equal dealing. Your clients will be treated probably, based on the level of service that they have, unequally. But is it fair? Is it equitable? Here, fair means equitable. The member candidate must not discriminate against any clients in disseminating recommendations or taking actions. So let's say that I have a recommendation and I decide that, well, I'm just going to give it to the people I really like, the ones that really treat me well. Well, that's not treating them fairly. All my clients are with me and paying me some money. They're paying me a fee for something. They're giving me one thing equally, their trust. It's not that one person trusts me a lot more than another. They've all given me their trust. That's my currency, is trust. The money I make is just the reward for the trust that I've generated. I must be loyal to that trust, not that money. A lot of people get that confused. They think they have to be loyal to the money. No, if you're loyal to the trust, the money just shows up. The money shows up on its own. You never even have to worry about that. Clients may be at different levels of service and different levels of fees. And that's what we mean by equitable versus equal. You don't have to give every client your equal time. Some of them may simply not be paying you for it. Some of them may be paying for saying, look, all I want to do is be in a passive fund. I'm going to give you $1,000 a month of my spare money, and you just keep putting in that fund, and that's it. I don't want to hear any of your recommendations. Don't try to upsell. I don't want to hear anything. Well, there you go. They're at the lowest level of service. They're still a client. You still owe them a duty of care. You still owe them loyalty, but you don't have to treat them. You don't have to treat them equally as far as the services and the time that you put in. I'm stressing this because as we go through life, so many people get those words confused, fair and equal. They're not the same thing. Fair means equitable. Equitable does not mean equal. It could mean it, but it doesn't necessarily mean equal. So levels of service, these must not result in unfair treatment now. Now, you can have different levels of service, but the different levels of service cannot result in unfair treatment. In other words, you cannot discriminate by it. You can't say, oh, you're only at the silver level. You see, that's why I ignore you and I take 3 days to return your calls. If you want the good service, you must come up to the gold level. So you can't say that you're getting terrible service because you're at a low level. You have to say you're getting great service at this low level. You can get greater array of services at the next level. So your first level must be great service, and then you move up from there. It can't be that, oh, well, once you reach this level, you'll have better service. Must not result in unfair treatment. Your service levels and your fees should be disclosed so that the clients can see exactly what service levels. They can choose their own service level. They can choose the fees they want to pay. And you must make it available to all clients. You can't just take some clients and say, you know what, I don't like this guy. I'll let him come in at the lowest level, but I'm certainly not going to spend any of my time with him. Well, then just turn his whole business away, period, as opposed to take a bit of it. If there's somebody you feel you can't work with, and listen, this is not a violation of anything, by the way. If there is a client that you feel you cannot work with because of outside personal issues, or whatever the case is, simply don't take them. You're allowed to do that. You're allowed to say, you know what? I don't want your money. I don't like the look of your face. And I don't like you. Get out. But you can't take their money, manage it, and then tell them you don't like the look of their face. You can't do that. But you don't have, if there's a client you don't want, don't take them. Then you don't owe them any duty whatsoever. But once you take them, that's it. Whatever personal feelings you have to bury it deep, and you got to treat that person equitably like everyone else for the level of service that they're paying for. So we got two categories here to get through for fair dealing. One is investment recommendations, the other is investment action. So let's deal with recommendations first. A recommendation is any opinion expressed by a member or candidate in regard to purchasing, holding, or selling an investment. May be disseminated to customers or clients or to anyone outside. So you can develop research that is really just for internal use and for client use only, or you're developing research that is for everybody. All clients must have a fair opportunity to act on the recommendation. They must all receive it and have a fair opportunity to act on it. You must prevent selective or discriminatory disclosure. By that, it means that, well, you're going to give it to the people who have the most money with you at first, and then the next day you'll send it down. You'll let the people at the top buy first so that the people with the least amount of money or your clients with the least amount of money with you get it last. And your argument to them would be, well, if only you put more money with me, you'd get access to all this beautiful information. You can't do that. Fair opportunity to act. Must prevent selective or discriminatory disclosure. Clients should be aware of the type of communication they will receive. In today's world, it's pretty much email. And for somebody to say, oh, I don't have email. How do you have money to invest and are successful enough that you have savings without email? That doesn't work. Everyone's got email. I think we can say that. Everyone's got a smartphone pretty much attached to them at all hours of the day. There are some people, I think, that they've just pretty much used crazy glue and put it in their hand because it never leaves their hand. They never put it down. And they stare at it every 3 seconds. Is it for me? Is it me? Is it me? Is it me? Is it mine? Somebody want to talk to me? Anyways, email is the easiest way. So as long as the client knows what type of communication they will receive, then everyone gets it at the same time. Or, let me rephrase that. Everyone has had the opportunity to receive it at the same time, whether they pay attention to it when the email comes in. They can't say, oh, I didn't look at it till just a few minutes ago. It's unfair. Well, you got it the same time everyone else did. Just because you looked at it later, nothing I can do about that. All right, well, we're still on investment recommendations. Changes in recommendations are more critical than initial ones. And that makes a lot of sense to me. Listen, if there was an earlier recommendation that said buy and I bought, and you have now changed your recommendation to a hold, I really want to know that. Changes are more critical than initial ones. Communicate it to all current clients, especially those who have acted on the earlier advice. In fact, if you're going to pick up the phone and start calling, hey, listen, we sent you out a recommendation. What do you think? You're going to want to put these people at the top of your list. At the top. Clients who place contrary orders should be advised before the order is accepted. So I send out an order today on something that's a sell. Client calls the next day and says, I'm thinking of buying 200 shares of this. My first statement should be, did you get my recommendation yesterday? Did you get my email? I got a sell on this thing. So the client may still say, I read your sell and the price is down significantly and that's why I want to buy. Now, okay. All right, as long as you're aware that I put a sell on this. So the question has to be asked. Let's move on to investment action. Treat all clients fairly in light of their investment objectives. For instance, allocation of new or secondary issues. Let's say there's an IPO coming and your firm has an allocation of it and you want to allocate it to your clients' accounts as well. You don't have to give it to everybody. That doesn't mean you're being unfair. You could simply say, look, this issue for this client is not suitable, and it's not suitable even at the portfolio level. Well, then that's it. Your duty of care is to that investment objective, is to the client, but to the investment objective of that client as well. And if it's not suitable, well, you don't have to allocate anything. But if you are going to allocate, if you have decided that it's suitable, you can't play favorites. You have to figure out, well, who's it suitable for? Where shall I put it? Are there other people who want it? Figure out how much you need, how much you're going to get, and go from there. If it's oversubscribed, in other words, your clients are demanding 20,000 shares, but you can only get 15,000, you have to prorate. You have to allocate based on a prorated basis. So if you can only get 75% of all the demand, everybody only gets 75% of their order. You can't just say, well, I'll fill everybody's order up here, and hey, guys at the bottom there, sorry, but we're out. You didn't. There was no allocation for you. The member or candidate should forego any personal allotments if issues are oversubscribed. That means if you can't satisfy all your clients first, then you got to sacrifice. Remember now, placing your clients' interests before your own or your employer's. Placing them before your own is an easy one to do. You're in full control of that. Placing them in front of your employers, that could be a conflict. And it could also be a conflict that places you in conflict with this standard. If a family member is a similarly treated client, in other words, if you have family members that have accounts with you, but they're just basically like any other client, they're paying for their services, then it's okay to treat them like any other client. Allocating to family members, that's not a big deal. But if they're not treated like any other client, if you're just buying on behalf of family accounts, then the clients come before you and your family. You should disclose your allocation procedure. 2 reasons why you should do this. 2 big reasons. Number 1, the client is fully aware that you are allocating. So if they only get 50% of their request, you could say, we have a written policy about this. You signed the forms when you signed up with this. You are aware of our allocation procedure. It's fair for everyone. I'm sorry, but that's it. So you're putting the client on notice that, look, you're not going to be bullied into filling their full order. This is the way it is. The second reason you want to disclose the allocation procedures is to keep you honest. If the client knows that they were supposed to get some allocation and you give them nothing, they can light a fire and hold your feet to it. That burns. The member or candidate must never use allocated securities as rewards or to gain benefit. And this comes from getting clients to upgrade their level of service with you for higher management fees, to say, look, if you were just at the gold level, look at all these people in their bathrobes listening to nice music. You could be one of these people. Upgrade. Recommended procedures for compliance. Develop firm policies. If none exist, you want to develop firm policies. The guiding rule in developing any policy behind fair dealing is no preferred or favored status. So if you design every policy around that saying no preferred or favored status, you're going to be okay. Let's have a look at some of these. All right, continuing on, and I know I got a busy screen here with a lot of words on it, but there was no easier way to do it. And there's not a lot of difficulty here, just a lot of words. Number 1, keep knowledge of impending recommendations to as few people as possible. The fewer people that know that a recommendation is coming out, the fewer people there are that are calling their clients and say, hey, just hang on for a couple of days. This is about to happen. Shorten the time between the decision to issue and the actual issue. Written guidelines for pre-dissemination behavior. So everyone's aware that a recommendation is coming out. How should everyone behave? Well, have written guidelines for that. Simultaneous disclosure, both internally and to clients. So you don't distribute it internally and then a couple days later send to your clients. Everyone all at the same time. Maintain a list of clients and their holdings. I mean, this is a throwback, I think, to the 80s and the 90s, maintain a list. This should be a database query. Simple as that. Run a query. Give me all the names and all the positions of everyone in this particular security, and your system should just be able to do it. So rather than maintain a list of clients and their holdings, it should be more along the lines of have an information system that allows this to be a single query. Who owns this? Give me their names, numbers, and their account managers, and let's go. Develop and document trade allocation procedures that ensure, number one, fairness to advisory clients in priority of execution. We'll talk about priority of execution shortly, and allocation of price, and I'll explain a little bit more of that shortly. In the timeliness or efficiency of order execution, and accurate member or client records. So that the trade allocation procedures will ensure that all of these things happen. All right, let's move more into allocations. And just a word before I continue on. I keep saying, and I've said it over a number of different standards now, that these written procedures help ensure that these things, either good things will happen or at least bad things won't happen. Let me clarify that a bit, because that just sounds kind of wishful thinking. Oh, if you write it down, it ensures something is going to happen the right way. A written policy doesn't ensure that it's going to happen. I keep saying that it does. On its own, the written policy doesn't ensure that the right things go on. But the lack of a written policy almost ensures that the right things won't happen, because it's too easy to say, that was never told to me. I didn't know that. I didn't know this. Once it's a written policy, it doesn't ensure, it heightens the probability that in the mind of the employee, this is an important thing I got to pay attention to. This is now part of my job. It's written down. It's codified. It's some serious stuff. So when we say written policies help ensure, they help ensure by the very presence of the written policy itself, as opposed to the absence of the policy, signifying that maybe it's not important. I mean, if it's not part of our policy, maybe it's not important here. So it just signifies to employees that, look, I've written it down, I'm aware of it, we think it's important, that's all. On its own, a manual doesn't get up and slap you across the face and say, hey, turn to page 15 in me and read me. You're doing something wrong. No, it doesn't do that. Allocations. All orders are time-stamped. Why are they time-stamped? Because of the second one. Orders are processed on a first-in, first-out basis. So if all orders are time-stamped, what you can do is you can match the order execution, the timestamp on the order execution, with when they came in to make sure that the first orders in were the first ones that were executed. Now, that may not always be an efficient way to get best execution. Remember, you have to get best price or best execution. Now, those are two things are not necessarily the same thing. Best price is the best price you can get in the market at that point in time. But best execution may not be the best price. Best execution says, look, I got a large amount that I have to execute. If I execute at the best price, I'll continue to push the best price way beyond what I want to. So it may be in my best interest to aggregate all of these orders and look for a large block order that might be a little bit higher. If I'm buying a little bit higher than where the market is, that'll give me the best execution of this whole order, but it doesn't necessarily mean that I hit the best price all the way through. But that by getting the best execution, I probably got the best average price. So you should have been, I think most people should be aware of the difference between best execution and best price. I just thought I'd put it out there. So orders are processed on a first-in, first-out basis, bundled when efficient, so that you may look at a timestamp on an execution for a large block trade, and in there is bundled a whole bunch of clients, whether they came first or not. So if that's the case, you're going to need a process to determine execution prices and partial fills for group trades. So let's say you have a large block order for 10,000, you get 7,500 filled, all at multiple prices. Well, how do you allocate those? The wrong thing to do is say, well, I'll start with the best price and give it to my best client first. My best client wanted 1,000 shares. What's the best price I got? I'll give them the 1,000 at that. Next client wanted 200 shares. I'll give them the next best price. You can't do that. What you have to do is find an average price for all the shares. One price. Everybody gets that one average price. Then you allocate on a pro rata basis. You got 75% of the order filled. Everybody gets 75% of what they wanted. Group orders all get the same execution price, prorated distribution on partial fills, and it's allocation by client rather than by portfolio manager. And finally, to finish up fair dealing, disclose allocation procedures. It's already mentioned. Let's mention it again. If the allocation process is unfair, this is important now. If the allocation process is unfair, just because you disclosed it, it does not exempt the member or candidate from 3B. So let's say that you have an unfair allocation process, but you disclose it, and your clients sign up with you anyways, even though the allocation procedure is unfair. That doesn't exempt you from fair dealing. You're still in violation. So disclosure doesn't allow you to say, I told everybody that this is the way it was going to be. That still doesn't work. It still must be fair. Systematic account review for suitability and for preferential treatment. Disclose levels of service, and it should not be offered selectively. These were mentioned earlier. That wraps up fair dealing. Standard 3C is suitability, and I made brief reference to this when we were dealing with Standard 3A. So let's see what it's defined as. When members or candidates are in an advisory relationship with a client, they must, and there's a bunch of things here, but let's be clear along the way. An advisory relationship, that's the key. With a client, they must make reasonable inquiry, investment experience, risk and return objectives, financial constraints. We've seen this all before in portfolio management. Must make reasonable inquiry prior to investment recommendations and taking investment action, and reassess and update regularly. Well, all of this is part of the IPS, all of that. Determine suitability, client's financial situation, and a client's written objectives in the context of the whole portfolio. So we can sort of read the whole thing. They must make reasonable inquiry prior to any recommendation or action and reassess and update regularly. They must determine suitability in the context of the whole portfolio. That is all portfolio management. So an important point I think that needs to be made is suitability does not mean no losses. You can find a security that's perfectly suitable for a particular client, given their objectives and their constraints, perfectly suitable. It feeds into diversification, lowers portfolio risk, has a positive expected return, but just because it has a positive expected return doesn't mean it's going to have a positive actual return. There are no guarantees in the market. Like they say, if you want a guarantee, go buy a toaster. But in today's world, that guarantee is probably not worth much anyways. If advisory relationship does not exist, that means you're managing to an index or a mandate. If it does not exist, the member or candidate may not be in a position to determine suitability. Because if I'm running a fund that its objective is large cap stocks and I'm managing to a specific mandate, I don't know who the clients in there are. I imagine that their financial advisors have determined that my fund is suitable for them, but that's not my deal. What if I'm in a position where I am managing money for clients and I am determining suitability, but a client calls up and says, hey, get me a couple hundred shares of this stock. That's called an unsolicited order. And now I'm in a position to judge suitability. I'm not selecting that stock. They are. I happen to know that it's not suitable for them. I tell them that. They still want it. What do? If the member or candidate knows such an order is unsuitable, they should get client to acknowledge that awareness. In other words, it's enough for me to say, look, this is not right for you for these particular reasons. And if the client says, well, I understand what you're saying, thanks for that, I still want you to get the 200, just make sure you say to them, but you do understand what I'm saying, that this is not suitable for you. And as long as the client acknowledges that, yes, I hear you, then you're good. You can't stop them from doing what they want to do. You can't stop them. You can only guide them. And to guide you, we have the code and standards. Managing to an index or mandate, there is no advisory relationship. Decisions should be consistent with the mandate. When the member or candidate is managing a portfolio to a specific mandate, we've touched upon this before, a specific mandate, strategy, or style, they must act in accordance with that mandate. So there is no beneficiary that they have to pay attention to. They must pay attention to the mandate. So let's get some guidance on suitability. And now much of the standard is covered in portfolio management study session, and we've been through that, especially the development of the IPS, the investment policy statement, assessing the client's risk profile in terms of the risk tolerance. And remember, we looked at it in terms of a two-dimensional construct, the ability to take risk and the willingness to take risk, and we take the lower of the two. And of course, update regularly. Also, diversification. All of this is in line with suitability. And let's wrap this up with some recommended procedures for compliance. The investment policy statement. Review portfolio management. Go back to that learning objective. Go back to that particular reading where we covered the investment policy statement. Everything in there deals with this. Regular updates and reviews, and the suitability test policies. Have some of these in place. What is the impact on diversification? So before you add something, perhaps you may have to make an assessment, maybe 1 or 2 sentences about the impact on diversification. Codify it, write it down. The fit with risk tolerance. The fit with the investment objectives. And if you can say positive impact on diversification, it fits with risk tolerance, it fits with the investment objectives, it passes the suitability test, it's a suitable investment. Standard 3C deals with performance presentation. So what do we got here? When communicating investment performance information, the member or candidate must make reasonable efforts to ensure that it is fair, accurate, and complete. And, you know I like to underline things. I'm going to underline what I think is the weakest word in the 3, which is complete. If there's going to be a violation of this standard, I say it is most likely going to be in the word complete. I think that most of the numbers I see are fair and accurate. Not all, but most of the numbers are fair and accurate. I would never have an issue there. It's with the word complete that I would have an issue. So what do we got here? Credible performance information. Avoid misstating or misleading both in presentation and measurement. You cannot state or imply that clients will experience a past performance level going forward, which is why when you look at any marketing information for any mutual fund, there's always a disclaimer at the bottom with a little asterisk that says, past investment performance and returns are not indicative of future performance and returns. You've always got to say that. Look, that's what we did. There's no guarantee we'll continue to do that, or that the environment and the markets will be in a position that it will allow us to do that. You can control and manage risk. You cannot control and manage the performance of the market. That will happen on its own. Analysts who are promoting their hit ratio, and what's a hit ratio? Well, it's a number of correct calls they make on the number of total calls that they make. So if you have a hit ratio, like our friend Kramer on Mad Money, of 40%, that means you make, out of 10 calls, 4 of them happen to be right. Even throwing darts at a dartboard, you should be able to get up to 50%. So, let's be careful about listening to somebody who makes a decision in 10 seconds and then throws a pig at the screen. So if you're promoting your hit ratio, you must present accurately and completely, and there's that word again, completely. So we will unpack that word and see what it means shortly. So some recommended procedures for compliance on your performance presentation. We're not going to go into a lot of detail here, and there's not a lot of recommended procedures because we're going to spend 2 readings on it. The investment performance standards, global investment performance standards, is the next 2 readings. After we get through all the standards, we're going to spend 2 readings on this, and they're not long. but they get to the point. So the recommended procedure for compliance is follow this standard. If you're not going to follow the standard, without the standard, include all accounts. That's what I mean by complete. Let's say that I have 10 accounts. 5 of them did really, really well, and 5 not so good. And I report my performance, and I take the 5 that did really well, and I say I have an average performance of this over 5 managed funds. You go, yeah, but I'm not including all my accounts. I'm just including my winners. Have you ever listened to somebody brag about how they do in the market? They'll tell you, oh, I made money on this, and I made money on that, and I made money on this. And you listen to them and you think, do you ever lose money? Well, they just don't talk about it. Of course they lose. They just don't talk about that. So you get the impression that, wow, this person really knows what they're doing. They're making money all the time. Because they're just telling you what they win at. They could be winning 2 out of every 10 trades, and they're only telling you about those 2. Nobody walks around saying, oh, I'm an idiot. You listen to how much money I lost today. Nobody walks around, bragging about how pathetic they are. Nobody does that. Nobody wants to talk about that. They just want to talk about their winners. That's what we mean about being complete. If somebody's going to lie to me, it's not so much that they're going to present unfair and inaccurate information on their winners. I think they're presenting fair and accurate information on their winners. The problem I have is they're only giving me winners. Tell me how you did on your losers. Now, if your winners did really well and the things you lost on, well, you lost a little but not a lot, I'm impressed. You've minimized your losses and maximized your gains. But if you got little wins and big losses, I'm unimpressed. Include terminated accounts. Why was the account terminated? Chances are you weren't performing up to the client's standards. They left you. Well, how did they do? Your presentation, is it gross or net of fees, gross or net of taxes, gross or net of inflation? You want to put that information up there as well. Maintain data and records used to calculate that performance. So if there's ever a question about it, you can say, here it is. Here's all the backup information you need to verify it. Standard 3E, the last standard in duties to clients. Preservation of confidentiality. The member or candidate must keep information about current, former, and prospective clients confidential unless, and we got 3 unlesses here, unless information concerns illegal activities on the part of the client. Number 2, disclosure is required by law. Or number 3, the client or prospective client permits it. So under these 3 conditions, you can go running off at the mouth. Without these 3 conditions, keep it shut. Now, number 2's got a little bit of a wrinkle in here. You have to preserve confidentiality unless it's required by law that you disclose. However, the law could also require confidentiality. It could go the other way. Instead of saying, well, you have to disclose this information to us. We're the law. Here's a court order. It might be the other way around, where under their constitution and under their laws, you must maintain confidentiality. So, here's the funny thing now. Even if number 1 above applies, you have information concerning illegal activity. Even if number 1 applies, you must follow the law. And if the law says you cannot disclose, and you do not disclose, even if something bad is going on, you would not be in violation of any standard, simply because one of the standards that we visited earlier under Standard 1A, which is to know the law, says you must follow the stricter of the laws. The code, the standards say that you can disclose if there's illegal activity going on, but if the law says you cannot disclose even if number 1 is going on, well, then you have to follow that law. So this standard really covers the member or candidate knowingly breaching confidentiality, saying things they shouldn't be saying, talking about private information regarding a client. But what happens if the member or candidate has information and somehow that information just gets stolen and gets released? Well, they didn't do it. They didn't breach confidentiality. So a lot of firms have policies meant to minimize that kind of thing happening, such as storing client information on personal laptops or on portable drives. All right. Here is something you should be aware of. This standard does not prevent you from cooperating with the CFA Institute's Professional Conduct Program. If they're looking into you and they request that you supply some client account information, you got to comply. It's not a violation of 3E to comply in that circumstance. Some recommended procedures for compliance. Well, follow this one rule. Don't disclose anything. What do you got to talk about people for? Just don't say anything. If it's information outside of the scope of the confidential relationship and does not involve illegal activity, it still may be okay to disclose that if it's outside of the scope of the relationship. So let's say that you know that a client is sitting on the board of directors of a specific charity, and somebody asks you, I'd like to have a contact for that particular charity. Do you know anybody on the board? Well, you have a client that's on the board. You know they're on the board, but let's say you knew that even before they became a client. You were aware of that. And maybe that's how you met them and was able to bring them in as a client. If that person asks you if you know someone, you say, yeah, I know so. I so-and-so sits on the board. They're a client of mine. Are you in violation of preservation of confidentiality? Well, not really. Because their being on the board is a public position. That's information that's freely available to anyone to look up. But if you suddenly give the other person this guy's private cell phone number, now you have a problem. You can mention that this person is on the board, and they can attempt to contact that person through normal public channels that the other person already provides, but you can't provide private access to them in just handing over a phone number. You can't say anything about what's written on their account form or anything about their holdings, anything about their finances, anything that's covered by that confidential relationship. But if they're out there publicly saying, I own 5% of General Motors, well, that's not confidential information anymore. They're publicly out there broadcasting exactly what they're doing, how much money they have, and everything. Well, then it's public information. So you can simply just repeat the public information that they're saying. Somebody says, does this person really own 5% of GM? You can say, well, the person admitted that they do. I have no reason to question that they would lie about anything without actually confirming it. You're not in violation of that if you're simply just giving out what's already public. Standard 4A, loyalty. And we're on standard 4 now, which is duties to employer. So we've left the duties to client behind. Now we're on duties to employer. And our first one is loyalty. That was the first standard when we were dealing with standard 3. A was a duty of care and loyalty to the client. Now we're dealing with loyalty to the employer. So let's see what this means, and we'll see where the two bump up against each other. In matters related to their employment, the member or candidate must act for the benefit of their employer and not deprive the employer of their skills and abilities. That's what you were hired for, right? Divulge confidential information. Now, this confidential information deals with the firm, not the clients. We've already covered the clients. You can't divulge confidential information about the clients. Here, this is duty to employer. You can't divulge confidential information about the firm or the business. And 3, cause harm to their employer. I know that I put a C over here, and I should put 3 to remain constant, right? Cause harm to their employer. Injure the firm, deprive it of profit, deprive it of your skills and abilities, etc. So I've kind of got a little bit of a hierarchy here. Client interests are greater than employer interests, and employer interests are greater than the member or candidate's interests. So if you can keep that in mind, it's client first, employer second, member candidate third. Aside, of course, from personal or family obligations, you're not expected to sacrifice your entire life for the firm. Although, depending on what firm you're with, it would be expected that you might think about doing that. Okay, so let's look at the employer responsibilities. And here's where a big wrinkle shows up. In the text, the curriculum doesn't offer much behind this, but note, employers are not obligated to adhere to the code and standards. Members and candidates are, however. So, what does the curriculum say? Firms should not adopt or develop conflicting practices. That's it, and that's where they leave it. They don't talk about, well, what happens if they do? The big explanation they give is, look, firms are going to want to retain the best people they can. CFA charter holders are the best, so if they want to keep CFA charter holders, they will not adopt or develop conflicting practices. Well, think about that for a minute. Let's say the firm just says, yeah, I don't care what your little institute says. This is the job, this is what it pays, these are our policies and practices, and you hold up your code and standards and point out 5 or 6 that are in conflict. That's not going to get you anywhere. That's just not going to get you anywhere, and that's it. So what do? Do you risk being in violation of those standards, or do you just throw your arms up and say, listen, one of the standards is loyalty to my employer. You can't have 5 or 6 standards in here that simply can never be satisfied because of their conflicting arrangements. If my employer is not bound by the code and standards, there's nothing I can do, and you can't stop me from working. So I think that's a huge problem. And the standard, the guidance for the standards, doesn't deal with it. In fact, it's very silent about that issue. I would have assumed that, what do you do when there are conflicts? It doesn't really address it. It doesn't say, well, here's what you do in a situation where there are clear conflicts between what the firm is doing and what the code says, because the firm is not bound by the code. But it doesn't. It's very, very silent on that issue. So because it's silent on that issue, I imagine they're well aware of how big a problem that is, and there is no easy solution, so why bring it up? Be aware of that the firm is not obligated to adhere to the code and standards. CFA charter holders are obligated to adhere to the code and standards. So, independent practice. Next one. The member or candidate must abstain from independent competitive activity that could conflict with the interests of the employer. This is saying don't compete with your employer. Now, here's the thing, and this is a sort of a tightrope here. The standard does not preclude you from doing so. When we read this one, it says we must abstain from independent competitive activity that could conflict. And here it's saying the standard does not preclude you from doing so. So you can go ahead and do it. But you just said I should abstain from it. Let's keep going. You can go ahead and do it. But it does require disclosure of intent to your employer, and they're okay. So you can say, look, and this happens all the time, where after a certain while you think, you know what, I'm going to go out on my own. CFA can't stop you from doing that. So this standard is written in such a sense that, look, you owe your employer something. Don't compete with your employer. But if you're going to, we understand that that many probably will. If you're going to, do it the right way. You tell your employer, look, I'm thinking about doing this. I'm already doing some of it, or I'm thinking of doing some of it. There's a group of us that are building a client list already. So whatever the case is, you disclose it to your employer that that's what you're going to do and get their okay on it. I don't know any employer, by the way, that would be okay with you competing with them while you're still working with them. I don't know any employer that would be okay with that, just to put that out there. So let's follow that up with leaving an employer. If you're going to compete with your employer, at some point you're probably going to have to leave. So leaving an employer, you must continue to act in the employer's best interest until resignation takes effect. If the member or candidate is leaving to compete, which is okay, by the way, the standard does not say you cannot. It is okay to leave and compete, but you must not appropriate trade secrets. Perhaps there's particular algorithms that they use. Misuse confidential information. Solicit employers' clients prior to leaving. Or take client lists. We're going to see a little bit more about what this list thing means shortly, but you can't do those. It is okay for the member or candidate to make arrangements to compete while still employed. You just can't do any of these things. So you can make arrangements in the sense that you draw up articles of incorporation, you meet with your team, you start building your marketing material, you do your figure out what services and fees you're going to offer, things like that. You can go ahead and plan your business and do a lot of that pre-startup work. That's okay to do. And it's okay to leave to compete. You just got to leave the right way. Continuing on with leaving an employer, it does not prohibit experience or knowledge gained at one employer from being used at another. This standard says, hey, listen, you probably gained some industry experience in a particular field or some knowledge about some company while you were working for your employer. I can't separate that from the person. Once it's in your brain, it's in your brain. Records or work performed that was codified are off limits. So let me be clear about this one. When we talk about records, these are client lists. Primarily, you can't touch those. Work performed that was codified. So let's say that you gained some experience on being able to program an Excel spreadsheet to do a whole bunch of amazing things. Nothing stopping you from using those skills and knowledge in your new position. But let's say that you built a spreadsheet, coded up and everything. You cannot take that file with you. That belongs to your previous employer. You can take the knowledge of how you did it with you because, well, it's in your head, but you cannot actually take the file. If you've done some incredible research on a particular industry and you've written it down and it's a research report, that's not your research report anymore. That's the firm's research report. Now, you're still aware of all of that information, but you would have to redo that in terms of writing it down and creating a new report. You would have to redo that on your own. You cannot take those old files with you or reuse any of that. You would be in the curious position of having to cite yourself to avoid plagiarism because even though it's your work, your employer owns that work. So if you were going to use major chunks of what you were paid to do for someone else, you would have to cite yourself. Isn't that cool? So it does not prevent the member or candidate from contacting previous clients. You're probably thinking, wait a minute, I thought you